Welcome to today's video, where we dive deep into some of the most crucial aspects of income tax. Have you ever wondered why sometimes, even the income of your spouse or child gets added to your tax liability? Or why some losses can be carried forward and adjusted against future profits? And most importantly, how can you save tax through deductions? If you want to gain a thorough understanding of these concepts and ensure that you optimize your tax planning efficiently, then stay with me till the end. Also, if you find value in this content, don't forget to like this video, share it with others, and subscribe to the channel for more insightful explanations on taxation and finance. Now, let's begin. Section A. Income of other persons included in assessee's total income, Section 60 to 65. The concept of clubbing of income ensures that taxpayers do not shift their taxable income to another person just to reduce their tax liability. The Income Tax Act specifies various scenarios under which the income of one person is clubbed with another person's income. Let's explore them one by one. Transfer of income without transfer of asset, Section 60. If an individual transfers income from an asset without transferring the asset itself, that income will still be taxed in the hands of the transferor. Example, if Mr. O owns a property and transfers only the rental income to his son but not the property itself, the rental income will be taxed in Mr. A's hands. Revocable transfer of assets, Section 61. If an individual transfers an asset to another person with a condition that it can be revoked at any time, the income from that asset is still taxable in the hands of the transferor. Income of spouse, Section 64, 1e. If an individual's spouse receives income from a concern where the individual has substantial interest, i.e., 20% or more voting power or share in profit, the income of the spouse is clubbed with that of the individual. Example, Mr. X is a partner in a firm and his wife is receiving a salary without doing any actual work. In this case, her salary will be added to Mr. X's income. Income of minor child, Section 64, 1a. Any income earned by a minor child is clubbed with the parent who has a higher taxable income, except in cases where the minor earns it through special skills or talent. A deduction of 1,500 rupees per child is available under this section. Income from asset transferred to spouse or son's wife, Section 64, 1iv and 64, 1b. If an individual transfers an asset to a spouse or daughter-in-law without adequate consideration, any income from that asset is clubbed with the transferor's income. Understanding these provisions is essential to avoid unintentional tax liability and plan better for tax-saving strategies. Section B. Aggregation of total income and set-off and carry-forward of losses, Section 66, 68, 69A to 69D, 70 to 75. Now, let's discuss how income is aggregated and how losses can be set off against profits. Unexplained income, Section 68 to 69D. If a taxpayer cannot explain the source of a sum credited to their books, it is considered as unexplained income and taxed at the highest slab rate. Similar provisions apply to unexplained investments, expenditure, and valuables found during searches. Set-off of losses, Section 70 and 71. Intra-head set-off, Section 70. Losses from one source under a particular head of income can be adjusted against profits from another source under the same head. Inter-head set-off, Section 71. If there is a loss under one head, e.g., business loss, it can be adjusted against income from another head, e.g., salary. Carry forward and set-off of losses, Section 72 to 75. Business loss, Section 72, can be carried forward for 8 years and set off against business profits. Loss from house property, Section 71b, can be carried forward for 8 years and set off only against house property income. Speculative business loss, Section 73, can only be set off against speculative business income and carried forward for 4 years. Capital losses, Section 74. Short-term capital loss can be set off against any capital gain, but long-term capital loss can only be set off against long-term capital gain. Understanding these provisions helps taxpayers manage their income effectively and minimize tax liabilities. Section C. Deductions to be made in computing total income, Sections 80C to 80U and 8OTER ATERA BYTE. Finally, let's discuss the various deductions available under Chapter 6-A to reduce taxable income. Section 80C, Max, 150,000 rupees. Investments like PPF, EPF, NSC, life insurance premiums, tuition fees, and ELSS qualify for this deduction. Section 80CCC and 80CCD. Contributions to pension funds, LIC, NPS, are covered under these sections. Section 80D, Medical Insurance Premium. Deduction of up to 25,000 rupees, 50,000 rupees for senior citizens for health insurance premiums. Section 80E, Education Loan Interest. Deduction for interest on education loans, available for 8 years. Section 80EE, 80EEA and 80EEB. Additional deductions for first-time homebuyers and electric vehicle loans. Section 80G, Donations to charitable institutions. 50% or 100% deduction based on government recognition. Section 80TTA and 80TERATERABYTE. Deduction of up to 10,000 rupees, 80TTA, for savings account interest and 50,000 rupees, 80TTB, for senior citizens bank interest. Section 80U, Disability Deduction. Fixed deduction for individuals with disabilities. By wisely using these deductions, taxpayers can significantly reduce their taxable income and overall tax burden. We have covered a lot today, from clubbing of income, set-off and carry-forward of losses, to deductions that help reduce tax liabilities. Understanding these provisions is crucial for effective tax planning. If you found this video helpful, don't forget to like, share, and subscribe to the channel for more insights on taxation and finance. See you in the next video.